Your friend gets a raise. They tell you they don't actually want it because they say moving into a higher tax bracket would mean they take home less money. Your friend is wrong about taxes and probably about a lot of other things too. Here is how taxes actually work in America in 2026. We are doing the whole thing in 7 minutes. By the end, you will understand your own paycheck better than 90% of the people around you. Let's start at the beginning. Income tax is a percentage of the money you earn each year that you send to the federal government. The federal government uses it to pay for the military, Social Security, roads, the IRS itself, and roughly 1,000 other things. If you work a normal job, your employer reports your wages to the IRS using a form called a 102. If you are self-employed, you report it yourself using a form called a 1099. Either way, once a year, usually by April 15th, you fill out a tax return and settle up. One thing trips everybody up. The amount you earn is not the amount that gets taxed. There is a step in between. Before the government taxes you, they let you subtract a flat amount of your income for free. That amount is called the standard deduction. In 2026, the standard deduction is $16,100 if you are single and $32,200 if you are married filing jointly. What does that mean in plain English? If you are single and you earned $50,000 this year, the government does not tax $50,000. They tax $33,900. The first $16,100 is free. This is the same for almost everybody. About 90% of Americans take the standard deduction. The other 10% itemize, which only makes sense if your specific deductions, mortgage interest, big charity donations, state taxes, add up to more than the standard amount. Here's the big one, the thing your friend got wrong. The United States has 7 tax brackets: 10%, 12, 22, 24, 32, 35, 37. Almost everybody pictures it like this. You earn a salary, the IRS picks the bracket your salary falls into, and they tax all of your money at that rate. That is wrong. Here's what actually happens. Imagine your taxable income is $80,000. The IRS does not just slap one rate on it. They take it in slices. The first slice, about $12,000 of it, gets taxed at 10%. The next slice, up to about $48,000, gets taxed at 12%. And the last slice, the part above $48,000, gets taxed at 22%. Even though your top slice is in the 22% bracket, you do not pay 22% on everything. You pay it on the part that sticks up into that bracket, which means, and this is the thing your friend got wrong, if you get a raise that pushes some of your income into the next bracket, only that extra money gets taxed at the higher rate. The rest stays the same. You never take home less by earning more. The rate on your top slice is called your marginal tax rate. The average rate you pay across all your income is your effective tax rate. The marginal rate is bigger. The effective rate is what your money actually feels. Now here's the part that confuses people every spring. If you wait until April to pay a year of taxes all at once, almost nobody could afford it. So the IRS makes your employer take a guess at how much you'll owe and pull it out of every paycheck. That is called withholding. The form you fill out when you start a job, the W-4, tells your employer how much to pull. 12 months later, you file your tax return. If your employer pulled out more than you actually owed, you get the difference back. That is a tax refund. If they pulled out less, you owe the IRS the difference. Most Americans get a refund. They are very happy about it. They shouldn't be. A refund is not a bonus. It is the government giving you back your own money, interest-free, a year later. If you are getting a giant refund every spring, you should adjust your W-4 so less is withheld, and you keep more of your money in your own pocket the whole year. 2 words people use as if they mean the same thing. They do not. A tax deduction reduces the amount of your income that gets taxed. If you are in the 22% bracket and you have a $1,000 deduction, you save $220. A tax credit reduces the actual tax you owe, dollar for dollar. A $1,000 credit saves you $1,000. Credits are way more powerful than deductions. The 2 big credits most Americans qualify for are the child tax credit, which gives you money for each kid you have, and the earned income tax credit, which gives low to moderate earners a real boost. There are also credits for college tuition, for buying an electric vehicle, for installing solar. The IRS uses credits to push you toward things they want you to do. Last summer, Congress passed the One Big Beautiful Bill Act. It made the 7 tax brackets permanent and added 3 brand new deductions that mostly matter for tax years 2025 through 2028. Number 1. If you earn tips, bartenders, servers, drivers, you can now deduct up to $25,000 of those tips from your taxable income, as long as your total income is under $150,000 single, $300,000 married. Number 2. If you earn overtime under the Fair Labor Standards Act, you can deduct up to $12,500 of that overtime, $25,000 for married couples. Number 3. If you are 65 or older, you get an extra $6,000 of deduction on top of the standard deduction. It phases out as your income rises above $75,000 single or $150,000 married. These are deductions, not credits. They reduce the income you get taxed on. They are also temporary, set to expire after 2028 unless Congress renews them. If you take one thing away from this video, take this. Taxes are not a surprise the government springs on you. They are a system. The brackets, the deductions, the credits, the withholding, all of it is published and predictable. You can plan around it. You can structure your salary, your benefits, your retirement contributions, your charitable giving to land exactly where you want to land. The people who pay the most tax aren't the ones who earn the most. They are the ones who never bothered to learn how the system works. Now you do. If this helped, subscribe. Next episode, I'm explaining what a Roth IRA actually is and why it might be the best deal the IRS offers.